Okay, so in this lesson, we're going to be covering level 2 understanding of market psychology. And the theme of this lesson is the relationship between pain and certainty of liquidity. So just to kind of preface the discussion we're going to have on this particular lesson, going back to the whole concept of pain and pleasure, that's my version of market psychology. I know there's more to it than that, but we're talking about market psychology in the way that it causes people to transact in the market. That's really what we're referring to here in my version of market psychology, having to play into the master pattern and how we trade technically. So this lesson we're going to be talking about the relationship between when someone feels pain, they get into a pain state, or they're in a trade that is losing, and the pain can also be from being in profit and then now losing your profit. That is also painful to lose unrealized gains, and also just going negative, meaning you're never really in a profit, just not working out. Also painful. So there's two different levels of pain there, and they all are associated with loss. But what we're talking about in this lesson is that there's a relationship between that pain and what it causes people to do, which is create certain liquidity. So the question is, how is certain liquidity harvested in the market from the bigger players? That's really what we're going to discuss. So, okay, so if pain is certain, profits are certain. So in the markets, it is a zero-sum game. Somebody is losing and somebody is winning. So it's very cut and dry that way. That's why this industry is so competitive. By its very nature, not everybody can win when it comes to trading. There has to be losers on the other end. And unfortunately, in this business, there is a lot of losers. And the ones that are winning are a very small percentage at the top. So the question that we always need to ask is, how is this little percentage of people, banks, institutions, really smart traders, how are they able to get a consistent profit when the majority of people lose? And it's so the distribution of the profits in the market is so skewed to this tiny minority of people that make money. It's like, why is that? They got to know something that is really, they have to know something that is a really integral piece of information when it comes to trading profitably, right? So that's what we're going to explore. That's really everything that we explore, because that's the entire quest of learning to trade right is really in search of that question. It's like, how does that tiny fraction make their money when the majority of everybody loses over time? It's really all about answering that question. And it's a complex question when you try to answer it. It's not super straightforward, but there's a lot that plays into that. And this, what we're going to discuss here, is a huge thing that really, I think, is one of the big explainers of why that happens. So if pain is certain, profits are certain. So let me start that again. Okay, so if pain is certain, profits are certain. The markets are controlled through pain and pleasure. We explored that in level 1 understanding of market psychology. Pleasure causes traders to be complacent and lax. Profits feel good. They're in the money. Everyone's popping champagne bottles and writing checks in their head, even though they don't have those as realized gains. Not actually in the bank yet. But everyone's like, let's see how high it'll go, right? Okay, so they're not taking immediate action. Pain causes certain immediate action. That's the difference between the responses. So that immediate action in the markets means liquidity, because you are transacting. You're pushing a button to get out of a trade, typically. The market makers need the certainty of liquidity to run their business profitably. They can't leave a whole lot to chance as a market maker, or let's just say as a bank in general. They are moving so much money that this has to be well planned. And that's really, for you guys, what's hard for a retail trader is because they don't think on that level because they don't have to. A retail trader has liquidity available to them all the time. You're not going to, sometimes we deal with a little bit of slippage, but as a general rule of thumb, you see an opportunity, like I see that, I want to trade that. I click the button, I'm now in the market, done. So you're looking at the market through the lens of your own goals and what you want to do. You actually have very few issues when it comes to transacting. Whereas if we flip that on its head, the banks have a lot of things, a lot of problems. Yes, if they want to trade a $100 pip, they could get in instantly too. The problem is you can't make a huge return on billions of dollars trading a $100 pip at a time. You simply can't. So they have to move a lot of money. And when you have to move a lot of money, you are dealing with mass psychology, because the only way they're moving their money is if they have a bunch of people agreeing to do the opposite of what they want to do, because they still need to make a profit. All those people need to be losers on the other end. So now where are we going with this? Imagine that the $50 or $100 pip that you want to trade for your own lifestyle, your own, what you want to accomplish. Pretend that you have to move that there's only enough liquidity to move that $1 at a time. You get in $1 pip here, $1 pip there, and then you get in $1, and then you need to wait 5 minutes or 10 minutes or 15 minutes to deploy your next dollar. How would you trade? Because you would have a liquidity crisis, right? You're like, I can't simply move the money I need to make. That's them relative to their size. So when you get news events, or you get what I like to call energy coming into the market, I don't care what the news is. What I care about is how much energy is it creating in the market. When you get that, then you get people willing to transact. And that's the first step. It's like, I just need to have people that are showing up to the party as a bank. So when they're willing to transact, now you can start to employ mass market psychological warfare through the news media. You can create all kinds of manipulative stories that go out through the media. And then on top of that, you can push around price to a certain degree to create patterns and to play along with a certain narrative that you're trying to push. And the entire point, if we're looking at from what is the outcome they're looking for? They're looking to make a profit, and they need people to trade with. That's the end of it. That's the end of the story at the end of the day. So what's going to give you guys an edge is understanding that what unlocks liquidity is pain in the market. So you're always on the lookout for where is the pain, because that's where the opportunity is. Not your pain, but other people's, right? And so if you always start from there, now you're starting to be in line with the banks, because at the end of the day, the only people that are going to push around the price is the banks. So you have to always look at how are they executing their business model. They need liquidity to get in, liquidity to get out. How can they take the situation that I'm looking at right now and manufacture a scenario that is going to put people in pain? Can I see where people are trapped? You guys know the market loves to push up. It gives a nice big move, and then it pulls back real fast, and then people go short. So they're long, then they go short, and then it ends right in the middle of that high and that low. And then so you got people that are just trapped in this weird space. It does it all the time. They do that on purpose. They get people to that point because now they can manipulate it above the high or below the recent low. They're always setting up the market to engineer liquidity later on. So anyway, that's getting a little more in the weeds here, but the whole point is that they count on certain liquidity. They cannot leave this to chance, so to the best of their ability. So they want to know where those stop losses are stacking up so that they know what they can accomplish if they nudge price to that level. And they can count on, because of human nature, they can count on that when they get to those prices, people are not going to change their human nature. They're going to be like, ouch, that hurts. Click the button. I'm done. And then that, again, that transaction is helping them move that massive amount of money that they need to move to make a return. So, all right, so let's keep going here. So market makers set up ways to guarantee liquidity. Pain guarantees action and liquidity. So we got another example here. So the P represents the pleasure state. So the market's starting to go up. We have people, we'll just say retail trader mindset. But this is just any trader that's making the decision to buy it as it goes up, right? And below that recent localized low, we have certain liquidity. So with that, as the market moves up, is going to come that pain threshold. That pain threshold is going to be right below that typically. And that's the whole thing that action threshold software, ATS, is based on. That's why I named it that, is because I want to know the threshold where people take action. And all the expansion lines, liquidity lines, all that are all action thresholds. So if we get over that threshold price, it's going to cause something to happen. Either liquidity or a belief change or something is happening at those levels. So, okay, as the market goes up, we have more people that are getting more confirmation that things are going. It's moving up. That's going to come with more beliefs, in this case buying, and it's going to come with certain liquidity down below that pullback, that little candle pullback there. As we keep going up, getting more confirmation, certain liquidity below that recent low right there, so on and so forth, and then it really takes off. This is kind of like max pleasure. Everyone's thinking like this is things, it's going, and they're feeling really good about it. But what we know is that when we see things that are easily set up like this, you could see these pullbacks. It did have pullbacks here, but nothing was too difficult really to get through. It's not, I can't see a whole lot of pain that was inflicted in this situation, right? So from our perspective, knowing how the banks make money, can they really do much with the situation as it is right now? Maybe they can if they have already accumulated. And that's where you got to look back in the chart and see where did they inflict pain? What is it likely that they're holding based off of those accumulation tactics? And then we go from there. But let's just say that this is the start of a new move out of a contraction period. It's just broken out and now it's going. Can much be done here in general? Again, unless the accumulation's already happened, then maybe. But as of right now, I would say no. There's nothing here that shows me that there's been any kind of opportunity created or manufactured by the banks. I can't see it. So what does that end up looking like? It looks like something like this. So as they drive the market down through those levels, they unlock that certain liquidity. Okay, and that reaches a max pain threshold, and then they have the ability to accumulate what they need to actually go make a profit. And also, too, what they've established, if they don't push it too far down, you notice that they only run it down to that very first level of certain liquidity. They don't want to push it too far past that, because now what they're also counting on is that if the market truly is going to go long, they could get these same people that they just harvested their stop losses to re-enter the market and fuel the move. So what they're going to do is something typically like this. They're going to reverse it, push it back up. Those same people that they just stopped out now get back in and help push that move. So the point with this is that what we are trying to do, and what I'm trying to teach you guys, is that this situation, the certainty, the pain and the certainty of liquidity really should be the leading indicator in your trading. It's not, we have to get out of the mindset of trying to be like, this is what I want to have happen. And that's what gets people to jump into breakouts and to do things that set up systems that are totally self-focused for your goals. At the end of the day, if you want the edge of the tiny percentage that actually make a profit, you have to get fully immersed in their headspace. We are really endeavoring to sit above everything. We not only want to look at what is retail likely thinking, but what is the banks, what are they thinking as well? And we're also trying to be aware of their business model, how they need to manufacture these situations. And we need to be aware of what the retail narrative is, what they're following, to see how they're essentially going to get taken advantage of and pushed around and manipulated. So we are really trying to be at the top level above all of this, looking down. So it's almost like you're looking at like two people play chess and you're betting on the one that you think's ahead and who's going to win. And one side is the banks and the other side is retail traders. And the bank is significantly better. So we're trying to sit above the entire thing and make decisions that way. And I always say, like, I think that we really have the best spot. Doesn't mean that it's easy. This is still really difficult to do, but this is the beginning. This understanding, particularly the pain and pleasure dynamics in the market, is the beginning of understanding the framework that really has to play out in order to provide the top percentage with a profit. If they don't have this scenario, it's very hard for them to make a profit. So we are trying to see when they're taking action, we're trying to mirror their actions and join in their profit-taking phase. So that's the scenario. I'm not going to go too much deeper into it, but that's what you guys need to know is that, what I was going to say before too, is that I think we have the best position from where we are right here, because you can not only, if you understand their tactics, you can look for them on that higher level, and you understand what the retail does as well. You can understand their mindset, and you can trade like the bank because you can see their activity and what they need to do, but you have none of their restrictions, because some of what they have to do is necessary, again, to manufacture liquidity so that they can make a profit. But you don't need to move billions of dollars. You're just trying to make a living. So you have all of their advantage of understanding how they run their business, but none of the drawbacks of trying to actually get in and transact, and you're not going to have any kind of liquidity problem. So it's really the best position. So, Brett, I'll address your question right here. So he says, what lot size do you think you can trade before you lose that liquidity? Good question. I haven't hit the threshold. So I think we had a discussion a long time ago with FXCM, with their like institutional department, and we're curious, asked that question. And this was like, back in the old institute days, but like you were able to trade a max of a $5,000 pip on their platform at that point. And we asked them, like, what's the slippage feel like on that? Because I personally, trading $200-$300 pips, I've seen it go to, they will separate that position into a bunch of positions. I have had that happen. But $5,000, never seen that happen, or I haven't had any experience with that personally. But they said that that'll execute pretty instantly, even at $5K per pip. So I don't know. I don't know what the threshold is of that, but I know that if you start getting above that, you're not really dealing with traditional brokers at that point. So it's kind of goes above and beyond that.
So I'm just looking at your chart here, and the question that I have now is it emotions, like our emotions, that are being managed within the market instead of the price?
Yep. So I mean, the emotion is what drives the transaction. So from a technical standpoint, it's all transactions. It's all people buying and selling. But these are not robots. I know that people will try to say, like, oh, you need to be robotic executing your strategy. You need to put emotion out of it. Why do they want to trade in the first place? What's the point? They're thinking about, while they're programming their robot and whatever they're doing, there is some emotional goal behind it. I want to take care of my family. I want freedom. I hate my job. I don't want to deal with my boss anymore. That's all extremely emotional. So the entire thing that draws people to this market is the idea of the freedom that it gives you. And that is going to bleed through in your decisions, because everybody that comes to this, particularly on the retail level, is desperate for a result. They want to get a result very, very badly. And that works against them in a lot of ways, because it causes them to emotionally transact when they shouldn't. And so we are trying to understand that. And a lot of it ends up coming to we not only need to manage our emotions, but we need to manage our expectations, because what is sold out there in the trading world is a fantastic idea that you're going to make a lot of progress and essentially get rich quick. And that is exactly the opposite of what you really need to do. It's not that you can't make good progress, but the problem is that when you try to go too fast, then you're trading too big of lot sizes, and you're doing things that are going to put you in a very vulnerable spot to experience more pain than you can handle. And that pain, at the end of the day, is going to create that certain liquidity that we're talking about, and then cause people to transact when they shouldn't be at the wrong time. So I don't know if that answers your question. All right. Yep. Thanks, bud. All right, so let's go ahead and we'll keep moving through our slide here. So what's the takeaway? Profits are not left to chance, especially when billions are at stake. Market makers and institutions will not simply hope for liquidity to enter the market. They will set things up so that liquidity is certain. And again, that comes with pain. We know that we can count on that human nature to kick in. So they are going to use that from a technical standpoint to do what they need to do. The way to guarantee liquidity is to guarantee action from other traders, and pain equals action. So as you guys go about your trading and start interacting with the market, this is, in my opinion, after 12 years, this is the best place to start from a mental standpoint when you approach the market. Understand that a consistent profit cannot be made without consistently taking money from people making the wrong decision. It is not about your indicators and your technical analysis and all those things. It is about an exchange from someone making a wrong decision to someone making the right decision. So everything that you do should be grounded in that as a basis before you ever make a trade, to figure out what decisions have been made by all parties and how am I going to align to that. And if it isn't clear on the chart, then that should be an indication that I shouldn't be doing anything yet, because I don't see the dynamics taking place in the market that provide consistency. If those dynamics are not present, you need to ask yourself, is there really an opportunity here? Because I can't see who I am personally taking money from. I don't see it and I don't get it. So can you do that repeatedly? No. Now you're just kind of shooting at the market. Your trade needs to be grounded in the basis of these consistent scenarios where that money is being transacted in the wrong way by retail and used by the banks to fuel profits. And when you see that, you see the clear picture, then that is when you're going to have everything that you need in your favor to have a repeatable strategy and approach to the market. Go for it.
Yeah, that pretty much sums it up. Just one thing that just came into my mind as you were speaking is that the bigger traders or the smarter money is playing on the retail emotions. And it's I guess it's kind of like looking for the spot in the pool where the fish are, and then just going and fishing there, right? It kind of sounds cliche-ish, but that's really what it comes down to. Isn't that right?
That's exactly right. You got to imagine the entire market was you in the room with 100 other people or 99 other people, right? All of you guys, that's all the money in the room, okay? All of you guys are not going to be sitting there trying to say like, hey, what are we all going to do? Let's all get like, the only way you're going to get money is if some of them make the wrong decision. So what would end up happening is you'd have people dividing off into teams and cutting deals, and then people would be trying to manipulate each other. They would all be trying to trade with each other to take each other's money. That's what we're dealing with here, just on a massive scale. So there is some camaraderie, like at ATS, because it is such a massive scale. There's so many traders. We are able to have a community like this where we can talk and try to help each other out. But at the end of the day, if it was only us, this wouldn't work. If it was literally us in this room trading with each other, it'd be cutthroat. So we are able to have these situations where we can break off and work as a group to help each other out. But it's only scales so far, because that's the zero-sum nature of the business, is that their emotions, they have to be manipulated some way into making the wrong decision, or they need to be taught something that doesn't work. And that's really, I think, the biggest problem for retail traders, is it is 100% left out what we're talking about. They do not have any thought. I know I didn't. When I got in, nobody told me, think how the bank needs to make money. They're the ones that have enough money to make a difference. Think about first how they're going to make their money, then you decide how you're going to make your money. Nobody told me that. I had to dig, because I thought, I'm in this. I feel like a pretty smart guy, yet I'm losing. Like, what's up? I thought this was supposed to be easy. And so I just thankfully learned quick. I'm like, I'm not looking in the right spot. So, that's really kind of the nature of it, is without starting there, then, you're going to be lost. And, and that's what we're trying to do here, is we're trying to create that collaborative group situation where we can help each other accomplish that. And thankfully, the market is big enough to where we could have this breakout group and we could achieve a decent level of success here among the group. And that's what we're trying to get to. But at the end of the day, it is very cutthroat. And, someone is unfortunately going to lose. And the industry counts on keeping people in that emotional state. They give them tools that keep them there. They give them things like high leverage. They give them things like prop account evaluations, which are good, but I've stated many times, if they're abused or they're not used in the correct way, it's just another tool to extract money from people. The entire industry preys off of the masses of this group of people to keep emotionally operating their business, because it's the fuel for the few that actually takes something away from it. So it's unfortunate. It has to be so skewed and so unfair. But if we're going to be in this business, you have to do an honest industry appraisal and understand this is how it works. You can see it clearly represented in the percentages of successful people. And you need to ask, what is the difference here? How are all these people, a lot of them very smart in other things. I've worked with people that are doctors, lawyers, really high-end professions that they've had to go to schooling and for, and they approach this market like, I'm smarter than the average guy. I have a degree. I have this. I'm, especially engineers. I can think through problems really well. And they come to this market and absolutely get their butt handed to them. And they cannot figure it out, like completely demoralized. It's because it's a whole different level of intelligence. It's something that they've never experienced before. So the mass marketing around this industry and everything is very powerful. It's very seductive. And people, even when they learn how the markets work, they're still so focused on that dream of, getting rich fast and going through that, going through the mainstream narrative and living that life that they try to sell, that they end up wasting 10, 15. I've seen guys 25 years still trying to figure that out. And it's unfortunate. It's sad. So the key is always like slower is faster at the end of the day in controlling your risk and having a long-term mindset. I know we're getting off topic there, but anyway, hopefully I answered your question somewhere along the way in there.
Yep.